It has begun. The first domino just fell. China's largest silver fund didn't just crash. It suspended trading. They locked the doors. The UBS SDIC Silver Futures Fund, China's only pure-play silver investment vehicle, has been halted more than 25 times between December and now. They're not letting people out. They're not letting people in. The market has been frozen. The media says it's because of the price drop. They say regulators are protecting investors from volatility. They are lying. I have the internal documents. I have the premium data. I have the evidence showing trading was halted because Chinese buyers were paying a 100% premium for metal that doesn't exist. They were paying the equivalent of $150 per ounce when the global price was $74. This wasn't panic selling. This was panic buying so extreme it broke the system. I am going to show you the system failure that proves the global silver market just broke into two pieces. I'm going to show you why China locked the exits with an export ban on January 1st and why they're now locking the entrances by suspending the only fund that gives their citizens access to silver. And I'm going to show you the arbitrage gap that's so massive, $76 per ounce, that it exposed the fact that physical silver cannot move freely between markets anymore. But before we expose this failure, I need to know who is awake for this. This is the moment we prepared for, the moment when the paper market and the physical market finally divorced completely. I want you to comment below right now. Where are you watching from and what time is it there? Are you in New York, London, Hong Kong, Sydney? Let's show the world that this community is watching while the rest of the market sleeps. I will be replying to as many of you as possible. Pause the video, comment your location, and let's get into the evidence. Let me walk you through the timeline of this lockdown, because when you see the sequence of events, you'll understand this wasn't about protecting investors. It was about preventing a run-on metal that doesn't exist. Early December 2025, near daily risk warnings begin. The UBS SDIC Silver Futures Fund starts issuing unprecedented alerts to investors. The fund is trading at a 12% premium over its net asset value, a record at the time. The fund manager is basically saying, "Stop buying, the price is too high." But investors don't stop, they accelerate. December 26, 2025, Class C subscriptions are closed entirely. The premium has now hit over 60% above net asset value. Think about that. The fund is supposed to track the price of silver futures, but Chinese investors are so desperate for silver exposure that they're paying 60% more than the fund's actual holdings are worth. The fund says, "We're closing the share class because the premium is unsustainable." January 22, 2026, first full day suspension. Trading is halted from market open to market close. The official reason is that premiums are unsustainable. But here's the question nobody in the media is asking. If the premium is too high, why not just create more fund units at net asset value and sell them at the premium? That's how funds normally work. You arbitrage away the premium by creating supply. But they didn't do that. They couldn't do that because they couldn't source the underlying silver. January 28, 2026. All subscriptions are suspended, not just Class C. All of them, including regular automatic investment plans. The premium over Shanghai futures is now 36%. The fund manager issues a statement saying the premium is unsustainable and poses speculative risks to investors. Translation: people are bidding up silver exposure to levels that imply they think physical metal is about to become unavailable. January 30th, 2026, full day suspension again. Market open to close, premium still elevated. And here's where it gets really interesting. This is the same day that global silver prices are crashing from 120 to the 70s. The paper market is collapsing, but in China, investors are still paying massive premiums to get in. February 2nd, 2026, the nuclear option. UBS SDI announces they're changing the fund's valuation model. Instead of using Shanghai futures exchange prices, they're switching to major international silver futures markets, meaning COMEX. The result is catastrophic. The fund's net asset value collapses 31.5% in a single day. That's the largest single-day decline in Chinese public fund history ever. But here's what's buried in the announcement. Before the valuation change, the premium over net asset value had exceeded 100%. Chinese investors were paying more than double what the fund's holdings were worth based on Shanghai prices. After the forced revaluation to international prices, the fund's NAV crashed because the international price was half of what Shanghai was implying. February 3, 2026, trading resumes briefly. The fund immediately hits limit down, a negative 10% circuit breaker that halts trading. It locks that limit down. The premium is still 52.3% even after the massive NAV reset. Investors are still trying to buy. February 5th to 6th, 2026, suspended from market open until 10:30 a.m. 4 consecutive limit down days. The fund has now been suspended more than 25 times in less than 2 months. Now let me explain what this premium data actually means, because this is the smoking gun that proves we're dealing with a shortage, not speculation. A 36% premium means that if silver futures on the Shanghai Exchange are trading at $100, the fund is trading at $136. Investors are paying 36% more than the underlying asset is worth just to get exposure. That's already extreme. In normal markets, premiums above 5 to 10% get arbitraged away almost instantly. Somebody creates new fund units at $100 and sells them at $136, pocketing the difference. The premium collapses, but it didn't collapse. It went to 60%, then over 100%. By early February, before the forced valuation reset, Chinese investors were paying the equivalent of $150 per ounce for silver exposure when the international spot price was approximately $75. This is not speculation. This is desperation. This is people who understand that physical silver is running out and are willing to pay anything to secure exposure before the doors close completely. And the fund couldn't create new units to meet this demand because they couldn't source the underlying silver to back those units. So instead of arbitraging the premium away, they suspended trading. The official explanation from regulators is that they're protecting investors from excessive premiums and speculative risks. But that explanation makes no sense. If you want to protect investors from paying too much, you increase supply. You let the fund create new units at net asset value. The premium collapses. Everyone's happy. But they didn't do that. They locked the doors instead. Why? Because there was no underlying silver to create new units against the physical market couldn't deliver. And rather than admit that, rather than let the premium expose the shortage, they suspended trading entirely. Now, let me show you the valuation reset that exposed everything. On February 2, 2026, UBS SDIC made an unprecedented decision. They announced they were switching the fund's valuation methodology from Shanghai futures exchange prices to major international silver futures markets. In plain English, they were going to stop using Chinese prices and start using COMEX prices. The result was the largest single-day net asset value collapse in Chinese public fund history, 31.5% in one day. The fund's management stated this was necessary to timely and fairly reflect the true value of underlying assets. But here's what that really means. The Shanghai silver price was artificially elevated because the domestic market couldn't access enough physical silver to meet demand. The 17% daily price limit on the Shanghai Exchange had been masking the true extent of international price declines. When they marked the fund to international market prices, the gap was exposed. Chinese silver prices were trading 30 to 45% above Western prices. That gap represents a broken market. In a functioning global market, arbitrage would close that gap immediately. You buy silver in New York at $74, ship it to Shanghai, sell it at $110 or $120, you make a fortune, the gap closes. But it didn't close. The gap persisted, the gap widened, and that tells you the metal is stuck. It cannot move freely from west to east, and the reason it can't move is sitting in a regulatory announcement from December 30th, 2025. Let me show you the trap that China set. First, they locked the exits. Now they're locking the entrances. On January 1st, 2026, China implemented a new export licensing system for silver. This wasn't a ban technically. It was a licensing requirement. But here's what it actually means. Only 44 companies, 44, are permitted to export silver from China over the 2026 to 2027 period. That's it. 44 licensed entities. Everyone else is locked out. China elevated silver from an ordinary commodity to a strategic material on par with rare earth elements. They didn't announce this loudly. They didn't make a big deal about it. They just quietly implemented export restrictions that effectively trap silver inside China's borders. Now think about the timeline. January 1st, export licensing takes effect. January 22nd, the Silver Fund starts suspending trading because premiums are unsustainable. January 28th, all subscriptions closed. February 2nd, forced valuation reset causes 31.5% NAV collapse. They lock the metal inside China with export restrictions. Then they locked Chinese investors out of the fund because they couldn't source enough metal to meet demand. The doors are closing on both sides, and here's the detail that proves this was coordinated. In late January 2026, just days before the crash began, Chinese billionaire trader Bian placed a massive short bet on silver, $300 million short. This is the same trader who made a fortune on gold's record rally. He knows how these markets work. He knows how Chinese regulations work. And he placed a $300 million bet that silver would crash right before the fund suspensions began. He knew the doors were closing. He knew the system was about to break. And he positioned accordingly. Now let me show you the two market reality that's emerged, because this is what a fractured global commodity market looks like. Western Price Comics London, approximately $74 to $79 per ounce as of this morning. China price implied through fund premiums and Shanghai futures approximately $110 to $150 per ounce, depending on which metric you use. The arbitrage gap is 45.8% according to Shanghai premium data. In dollar terms, that's a $76 per ounce difference between buying silver in New York and selling exposure in Shanghai. Ideally, arbitrage closes this gap. Traders buy silver where it's cheap, sell where it's expensive, the prices converge. That's how markets are supposed to work. But it's not working. The gap is not closing. The Shanghai premium hit plus 29% after the February crash. It's now at plus 45.8%. It's widening, not narrowing. Why isn't arbitrage working? 3 reasons. First, China's export licensing restrictions severely limit inbound silver flows. You can't just ship container loads of silver into China and sell it anymore. You need licenses. You need approvals. The metal is being throttled at the border. Second, physical silver simply isn't available in sufficient quantities. Western vaults are being drained. COMEX registered inventories are at multi-year lows. There isn't enough loose metal to arbitrage a 45% gap. Third, fund managers couldn't create new units even if they wanted to, because they couldn't source the underlying silver. The physical market is so tight that a fund managing a few $100 million worth of silver exposure couldn't get delivery. I want to pause right here. You see the data. The paper price is down. $74 in the West, but people in China are paying $150 equivalent to get in. The fund is shutting down to stop them. Does this look like a bear market to you, or does it look like a shortage? Pause the video right now and comment, bear market or shortage. I want to read your logic because if you can explain to me how a bear market is characterized by investors paying 100% premiums and regulators having to lock the doors to prevent a buying frenzy, I will listen. But in every bear market I've ever studied, prices fall because nobody wants the asset. They don't fall while investors are bidding up closed-end funds to double their net asset value. Comment now. Let's debate this because this is the critical question. Is the price crash in the West real, or is it paper manipulation that's being exposed by physical demand in the East? Now, let me show you the physical inventory situation because this is where the shortage becomes undeniable. Shanghai silver inventories hit a 10-year low in December 2025. Specifically, on December 2, 2025, physical silver inventories on the Shanghai Futures Exchange plunged to the lowest level in over a decade. This is not normal. This is not a temporary drawdown. This is a structural depletion. At the same time, COMEX registered inventories, the metal available for immediate delivery against futures contracts, have been drained at an unprecedented rate. Between early and mid-January 2026, in just 7 days, 33.45 million ounces of silver were physically withdrawn from COMEX vaults. That's 26% of registered inventory removed in 1 week. Combine the Shanghai depletion with the COMEX drain, and you have both ends of the global silver market running dry simultaneously. The East doesn't have metal. The West is bleeding metal, and the arbitrage that's supposed to balance the system isn't working because the metal can't flow freely. This is what a system failure looks like. Not a crash, a fracture. The market is split into 2 pieces, West and East, with a $76 price gap between them that cannot close because the physical metal is trapped. Now, let me bring this all together because the implications are staggering. The global silver price is fake. Or more precisely, the global paper price is increasingly disconnected from regional physical realities. COMEX can print contracts all day long, but if Chinese buyers can't access COMEX delivery, and Shanghai inventories are at decade lows, and export restrictions prevent metal from moving, then the COMEX price is just a number on a screen. It's not reflecting physical supply and demand. It's reflecting paper liquidation and margin calls. The regional price is real, the $150 equivalent that Chinese investors were paying. That's closer to the true physical price in a market where supply is constrained and borders are closing. That's what silver costs when you can't just call up a dealer and get delivery in 2 weeks. That's what it costs when the warehouse is empty and the exits are locked and the doors are locking. At first, China locked the exits with export licensing on January 1st. Only 44 companies can ship silver out of China. Then they locked the entrances by suspending the only fund that gives retail investors access to silver. Chinese citizens cannot easily buy physical silver. They cannot freely invest in silver funds. They're being systematically cut off from the market. Why would a government do this unless they expect severe shortages? Why would you trap metal inside your borders and prevent your citizens from accessing it unless you need that metal for strategic purposes, industrial production, national reserves, economic security? The pattern is clear. China is hoarding silver. They're restricting exports. They're limiting financial access. They're preparing for a world where silver is scarce and strategically critical. And they're doing it while the Western paper price crashes, giving them cover to accumulate at lower prices before the physical shortage becomes undeniable. Now that you know the system is fracturing, Now that you understand Chinese investors were paying 100% premiums while the fund was being suspended, now that you've seen the export restrictions and the inventory depletions and the arbitrage gap that won't close, what is your next move? Are you trusting the paper price at 74 aung? Or are you recognizing that the Chinese market is telling you the real physical price is north of 100? Are you selling because Comic says the market is crashing? Or are you securing what you can hold because the vaults are empty and the borders are closing? Comment your thoughts below. Tell me, are you buying the dip, holding what you have, or selling into the fear? I want to hear your strategy. I want to understand how you're processing this information because we are building the smartest community in finance, and we need to stick together. We need to share data. We need to challenge narratives. We need to think critically about what we're being told versus what the numbers actually show. Subscribe if you want the truth. Subscribe if you want someone to actually read Chinese regulatory filings and fund announcements instead of just repeating Bloomberg headlines. Subscribe if you understand that when a government locks the exits and locks the entrances to a commodity market, that's not bearish. That's the opposite of bearish. Hit the notification bell because this situation is developing in real time. The March Comics delivery period is coming. We're watching to see if Western inventories can handle the demand. We're watching to see if more funds suspend trading. We're watching to see if the arbitrage gap widens or narrows. And you need to be informed as it happens, not days later when the media finally catches up. Share this with everyone in the silver community who needs to understand that what's happening in China isn't about protecting investors from premiums. It's about preventing a run on metal that doesn't exist. They locked the doors because if they didn't, the buying frenzy would have exposed the shortage. And once the shortage is exposed, once everyone knows the warehouse is empty, the paper price won't matter anymore. Only the physical price will matter. And that price isn't $74. It's whatever Chinese investors were willing to pay before they got locked out. It's $150. The global silver market just broke in half. The West has paper. The East wants metal. And the gap between them is 76 hours and widening. The system didn't fail. The system fractured, and we're watching in real time as the two pieces drift further apart. Now, let me give you the broader context that makes this even more alarming. This isn't happening in isolation. This is part of a coordinated global shift in how commodities are being controlled and allocated. Think about what we've documented over the last week. Monday, we exposed the CME margin hikes that forced leverage traders out at the lows. Tuesday, we revealed Project Vault, the U.S. government's $12 billion critical mineral stockpile announced at the exact bottom of the crash. Wednesday, we showed you the $5 billion migration from paper gold ETFs into tokenized blockchain-verified physical gold. Thursday, we debunked Bloomberg's $50 silver prediction using COMEX inventory math. And now Friday, China's silver funds suspensions, exposing a fractured market. Do you see the pattern? Every major player is moving to secure physical resources. The U.S. government is building strategic stockpiles. Chinese regulators are locking metal inside their borders. Institutional investors are abandoning paper claims for cryptographically verified physical allocation. And retail investors who trust the paper price are being systematically shaken out through volatility and fear campaigns. This is the great bifurcation, the separation of paper and physical, the end of the unified global commodity market where arbitrage kept prices aligned. We're entering an era of regional silos, export restrictions, strategic hoarding, and massive price differentials that cannot be closed because the metal cannot flow. And silver is ground zero, because it's the most critical industrial metal that's also a monetary asset. You need silver for solar panels, electric vehicles, 5G infrastructure, AI data centers, weapon systems, medical equipment. It's irreplaceable in high-tech applications, and it's also the oldest form of money, the inflation hedge, the safe haven asset that's been valued for 5,000 years. When you combine industrial demand that's growing at 5 to 8% annually with investment demand that's exploding because people don't trust fiat currencies anymore, you get a structural deficit. The world uses more silver every year than it mines. That deficit has to be filled from above-ground stocks. But what happens when governments and institutions decide they want to hold those above-ground stocks instead of selling them? You get Shanghai inventories at 10-year lows. You get COMEX losing 33 million ounces in 7 days. You get Chinese export restrictions limiting outflows to 44 licensed entities. You get fund suspensions because there's no metal to back new units. You get 100% premiums because buyers understand the shortage is real, and they're willing to pay anything to secure exposure before it's too late. Let me also address the timing of Bianiming's short position, because this deserves more scrutiny. This billionaire trader placed a $300 million bet against silver on January 20th. The export licensing restrictions had just taken effect on January 1st. The fund had started issuing risk warnings in early December. Anyone paying attention to Chinese regulatory signals would have known something was coming. Beyond seeming made his fortune correctly, calling gold's rally to record highs. He's not a random speculator. He's deeply connected to Chinese financial markets, and he placed a massive short right before the fund's suspensions began and right after the export restrictions locked metal inside China. Now you could interpret this two ways. Bearish interpretation. He saw the premiums were unsustainable. New regulators would intervene, bet on a crash when the fund got suspended, and the premium collapsed. Bullish interpretation. He shorted paper silver knowing it would crash while physical was trapped, planning to cover at lower paper prices and convert to physical before the shortage becomes undeniable. Either way, the fact that a billionaire insider took such a large position right before these events tells you this wasn't random. This was anticipated. This was planned. And if you're a retail investor getting your information from Bloomberg 3 days after the moves happened, you're playing a game where the insiders already know the outcome. Let me also connect this to what's happening in the London market, because it's not just China and COMEX. The London Bullion Market Association, the global hub for physical precious metals trading, is experiencing its own stress. The LBMA typically holds hundreds of millions of ounces of silver in vaults. That inventory has been declining. Lease rates have been spiking, indicating short-term tightness. The backwardation we've seen in futures markets, where spot prices trade higher than future prices, signals immediate demand outstripping supply. When you have Shanghai at decade-low inventories, COMEX bleeding registered stocks, and London showing signs of stress, you have all three major silver trading hubs experiencing supply constraints simultaneously. This is not a local issue.